And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Wednesday, the hump day edition of The Real Investment Show. It's also the first day of October, which also means the government shut down last night. So we'll talk a little bit about that, what that means for markets, historically, what that has meant for markets over time. Of course, a lot of it depends on how long the government shut down. We touched a little bit on this yesterday, just talking about what happens during the government shutdown. But we'll recap a little bit of that today, just in case you missed the show yesterday. Again, there's going to be lots of headlines out this morning on everything else talking about government shutdown, and we'll kind of dig into what it actually means. But outside of that, economic data still continues to be okay. Now, one of the risks that we're going to have with this shutdown is that we're supposed to have an employment report on Friday. That's probably not going to happen at this point. So that'll be delayed. Most likely, that will be delayed because of the shutdown. So again, markets are going to kind of struggle with not having the data that they're used to having in terms of working with. But, we'll see what happens. But markets continue to do okay here. Again, we're now entering into the seasonally strong period of the year. So here's what you need to know before the bell this morning. October begins the seasonally strong 6 months of the year. So October, November, December, January, February, March. Those tend to be the strongest months of the year. And historically, October turns out about a 1% advance. Here's the interesting thing, though, is that right now, we've had 5 straight months in a row of advance. So 1, 2, 3, 4, 5. So we've had 5 monthly gains in the S&P 500 index. And this occurred, during the seasonally weak period of the year as well. So again, when markets just kind of gravitate higher over a period of time, that's fine. But, as we talked about before, you get these deviations from moving averages and you get overbought conditions, and those typically tend to lead to some reversals. But 5 months advance, 5 months in advance is getting to be on the fairly long end of the streak. If you go back historically and look, you get 5 months here, you have a month down. Again, it doesn't mean the market's correct, have a massive correction. But once you have 5, 6 months in a row, you typically get a market that pulls back again. So 1, 2, 3, 4, 5, you have a correction for a month. 1, 2, 3, 4, 5, you have a correction for a month. Of course, then you had this kind of topping process that led to the April, and you've had now 5 months in a row. You'll see that pattern repeat all throughout history. Now, are there periods where you went longer than 5 months before a month, kind of a month correction period? Yes, of course, we've gone 6 months, 7 months. And again, but those get to be a little bit more abnormal. I've written some reports about this before. But again, that's just the momentum chase in the market. So even though we're about to enter into the seasonally strong period of the year, don't be surprised that if we see a little bit of a corrective action here at some point, maybe October turns out to be a little bit weaker month just because of this, or you have a correction in November or December. That wouldn't be surprising here at all. But again, it's just a function that when you have this much of an advance over a short period of time, markets typically have like a cooling off period. Again, that's all we're talking about here. We're not talking about a major correction of any sort, but the market kind of needs to reset itself a bit, come down, reset on moving averages in some manner. So a 3, 4, 5% correction during the period of a month would not be surprising at all at this juncture. And then that would set you up for kind of the year-end rally. Again, doesn't have to happen, but it's just something to be thinking about, particularly given, that markets are, again, deviated from long-term moving averages. This recent kind of sell-off that we had a few days ago that retested the 20-day moving average did work off relative strength a bit, but it's recovered most of that over the last couple of days. Again, it's just, this is where we are, but again, just seasonally speaking now, we are entering in that stronger period of the year. Again, as we talked about before, we're about to get into earnings season. That will start up in about 2 weeks in earnest. Then we'll have corporate buybacks starting to open back up by the end of the month. That'll provide additional buying support. You have a lot of momentum in the market. And then right now you've got a lot of professionals that are still kind of lagging the markets at this point in terms of allocations. See some catch up with that by the end of the year. So there's kind of 3 supports here that are potentially going to keep prices kind of moving forward at this point and at least providing some support for the markets here over the next couple of months. Again, but let me just restate, it doesn't mean that there can't be a correction along the way. So it just doesn't mean blue skies from here, but it does suggest that prices will probably be higher by the end of the year than they are right now. So I know, just the way it is, kind of crazy. But that's what you need to know before the bell this morning. When we come back, we'll talk about government shutdown, the infinite money glitch, a few other things we've got to cover this morning. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Down just a little bit this morning. Again, not surprising after the rally we've had over the last 3 days that you're going to have a little bit of a, kind of maybe some profit taking on the back of this idea that, the government's shutting down here and, what does all this mean? Concerns about, all these things that matter. And again, just to recap a little bit about what we talked about yesterday is that government shutdowns are not the thing that they tend to be in the media. I mean, like you look at any media headline right now, right? Government shutdown now in effect on Fox News, CNBC, a guide to life without payrolls. Oh my gosh, we don't have a payroll number. What are we going to do? It's just, we're just flying blind in the markets. Really? We haven't really paid attention to the payroll data in months. The markets are going up. Everybody's doing just fine, and payrolls have been a lot weaker than expected. And we have ADP, we have paychecks, we have all these other payroll data that we can look at to get an assumption of what's going on with payrolls. But, oh my gosh, we don't have a government report to live by. What are we going to do? This is just terrible, right? Look, we survived this. Government shutdowns come and go. We've gone through these numerous times over the last, really, we've had them in the past, but since 2008, they've become a much more frequent thing because we don't work on a budget now. We just do continuing resolutions. But again, let's just kind of recap what it does and does not mean, right? It does not mean that we're going to default on our debt because interest payments are a mandatory spending item. They get paid regardless. Does not mean that veterans, military people serving in the military, they still get paid. People don't lose their veterans benefits. People in the military still get their paychecks on time, shows up, it's mandatory spending. Social Security gets paid. It's mandatory spending. Anything in the mandatory spending category gets paid regardless of the shutdown. The shutdown only affects areas of spending that are discretionary in nature, which is only about 25% of the budget. And it only affects people that are considered not important, just to put it that way. People that are not involved in personal safety, protection of property, they're at risk of being furloughed. And as we talked about, that's about 900,000 people serving in the government, maybe closer to 1 million. And that is going to suggest that we're going to see an uptick in the unemployment rate when we actually get the data. Now, when will we get the data? The data will come as soon as the government reopens. You'll be prepared. The government will send it out. Everybody that got laid off or furloughed, I should say, come back to work. They get full back pay. So they don't lose any money while they're on furlough, while the government's shut down. But this is why you've seen in the past that, there was a bunch of hubbub when the government was shut down during the Obama administration. We shut down national parks. Everybody's like, oh my gosh, we're shutting down national parks. It's terrible. What are all these people going to do that need to go to the park? But that's the consequence of it. So it's the government shutdown only impacts areas of the economy that are discretionary in nature, right? So if they're mandatory, they still get paid. So if anybody, throws an article in front of you that says, oh, we're about to default on our debt because of the government shutdown, those evil Republicans, no, that doesn't happen. And it won't happen. So again, want to keep those things kind of in perspective. But again, this is going to be the dominant headline here over the course of the next few days, as long as this lasts. Again, headlines running rampant this morning. CNBC, their headline on their website: government shutdown, live updates. We're going to track this live in terms of the government shutdown. This is how important this is. Funding ends after Trump GOP Democrats fail to cut a deal. So, it'll be short. There will be a resolution that gets passed, but that's the bigger problem. Maybe we don't need a short situation in government. Maybe we need to let the government be shut down, and it only opens once you have a budget put into place and we go back to operating on a budget. Because as we've talked about before here on the show, the problem with continuing resolutions, which are fine, right? All a continuing resolution is it just says, okay, Brent spent $1 million last year, so we're going to do a continuing resolution to provide him $1 million this year. He's very excited right now because he gets $1 million. And not only are we going to give him $1 million, we're going to increase that by 8% this year. That's what a continuing resolution is. We take last year's spending, stick 8% on it, and that's the new continuing resolution, plus whatever other little stuff they want to put into that bill to get it passed, right? Because there's always the backdoor ponying up of things like, okay, well, you want an Air Force base put over here, you want this or you want that, then we'll put that. We'll provide that in the bill. But at its very core, a continuing resolution simply just takes last year's spending, adds 8% to it. That's this year's spending. And that's why government spending has been doubling about every 8 years, rule of 72. And this is why the deficit continues to be a problem. This is why we keep talking about, the spending problem in government. This is why we talk about the debt issues, those type of things. It's because of these continuing resolutions. Instead of having a budget to where you could actually cut spending, having a budget would say, hey, here's what we're going to spend money on. We could actually cut spending and not necessarily have an 8% automated increase. But continuing resolutions are now a very easy thing. It's just simply a process. We no longer have to go through the rigors of actually doing a budget, that four-letter word that nobody likes. But because of that, this will be a fairly short event, most likely. Maybe the government shut down a week or two. The longest shutdown we've had on record is, I think, 35 weeks. That's a fairly long time. But again, the world did not die during that shutdown period, despite a lot of comments and commentary to the contrary. Here is a chart. See if I can find this real quick. So, yeah, this is the history of shutdown drama. Going back to 1976. And this table lists basically every shutdown, the length in terms of days that the government was actually shut down, when it was shut down, when it was reopened, and length in days. And I said 35 weeks earlier, and that's my apology. 35 days was the longest one, and that was in 2018. That was our last government shutdown that we had. What's important to note is that the S&P was up about 85% of the time. Yields were lower, stocks were higher, because nobody cares about shutdowns. even though we're all running around waving our arms and stuff, talking about, you know, the debt, the deficits, and all these type of things, we really don't care about shutdowns that's, you know, in terms of everything else, because, again, markets know that this is going to be a very temporary issue at best. And so, again, this is, while it's certainly concerning, you'll also see that these shutdowns are not one party or the other. They are bipartisan across time. So these shutdowns are not uncommon. Again, they've happened throughout history, and the markets continue to move forward. And that's the important takeaway. So I would pay very, very little attention to the headlines. And if you're worrying about, oh my gosh, what does this mean for my portfolio, whatever, this is going to cause markets to crash. No, there's no history. Could this time be different? Sure. This time could be different. I'll give you that. This time is different because of this, that, or the other thing. Sure, I'll give you that. But statistically speaking, and looking at the historical data, it suggests that concerns should be minimized, because this, as the old saying goes, this too shall pass. William Lee, chief economist at the Milken Institute, noted this shutdown could have a greater impact on the economy than previous ones. So I'm going to give you this. Quote from him. The history of shutdowns really has had so little impact on the real economy, because essentially by the end of shutdowns, everything goes back to the way it was. But this time, there may be some big changes, because both sides are being very strategic about it. The Republicans are saying that this is a good time for us to implement the kind of changes that Elon Musk put into place with Doge. The Democrats are really bearing down and saying this is our turn to be strategic and get back to the legislation we want put in place. All that means is that this gets drawn out potentially a little bit longer. That's all that means. Because what that statement really means is that this time really isn't different, but as we saw back in 2018, it lasted 35 days. And that was because of the negotiations. This will end with negotiations with both parties getting something of what they want. The Republican side of the House will get things that they want in terms of spending cuts, whatever it is. The Democrat side of the House will get spending bills that they want for whatever their issues are. Their kind of big primary focus is Obamacare subsidies. So again, that's going to be one of the key debates about the shutdown, will be about Obamacare subsidies. And of course, you'll hear a lot of headlines is like, oh, the shutdown is going to cause people to lose health care and their insurance premiums to go through the roof, et cetera. Yeah, that's because of the lack of subsidies. If the government isn't supporting, if your tax dollars are not going to support the health care benefits of Americans that are on Obamacare, or the Affordable Care Act, it will cause their premiums to go up. Yes, that is a true statement. So that's going to be one of the big contentious parts about this, is going to be those continuations of those government subsidies to support the Affordable Care Act, which is neither affordable or careful. But it's there. So anyway, enough of that. I think you've got the right idea of what's going down. But this is just a function of things that are going on. It's nothing to fear in the financial markets at the end of the day. Could it cause some short-term angst in the markets? Absolutely. But again, it's not something that I would be overly concerned about at this juncture. Again, I don't want to take off the table entirely that something could go awry. It certainly could. But it won't be a debt default. The markets will figure out how to live without employment data temporarily as well. All right. Let's talk about something else that's been running around the media as of late, because, again, this is very interesting. And this is going on in the AI space. And this is going on in this kind of a historical look back in history. to the late 1990s when we're talking about the dot-com crisis, or the dot-com bubble, sorry. Back then, if you don't remember, or if you weren't around, during the dot-com boom, there were a lot of companies just coming along and changing their name to this or changing their name to that, adding a .com onto it, and then their valuations would go up dramatically. We're seeing this not only in the AI market, but also in the Bitcoin's kind of the Bitcoin space as well. We actually just touched on this just a tad yesterday in our daily market commentary, that there is a company that is a textile company. They make kimonos in Japan. And what's interesting is that over the last couple of years, and this is all going to come back to the infinite money glitch, but just bear with me for a sec. We just kind of lay out the premise of what we saw in the late 90s, because we're seeing a lot of that repeat of it right now. So MicroStrategy started this thing about using Bitcoin as a treasury. And so they were MicroStrategy's buying Bitcoin, putting it on their books. They're issuing debt to buy more Bitcoin. They're issuing preferred shares to buy Bitcoin, etc. So they're leveraging against Bitcoin and holding Bitcoin. And so other companies, GameStop, have kind of seen where MicroStrategy started doing this kind of treasury play on Bitcoin, even though MicroStrategy itself was a business on the verge of obsolescence. They make software that nobody was using for the most part. And so that company was on the verge of going out of business. And then Michael Saylor comes along and says, hey, I think I'll just start buying Bitcoin. Nobody looks at MicroStrategy for their core business, which is failing. They just look at it for their Bitcoin holdings. So other companies that were failing are now doing the same thing. GameStop. And now this company in Japan, Marusho Hotta, which makes kimonos. They're a textile company. And in our Simple Visor portfolios, in our thematic models, we just recently launched a crypto portfolio. And in that portfolio was a related company to Marusho Hotta. It was actually one of their shareholders. That stock was up 50% on Tuesday. But what happened is that Marusho Hotta, which has been manufacturing kimonos since 1861, so they've been around a while, they're going to rebrand as Bitcoin Japan Corporation. The transformation, I'm reading this from our daily market commentary that we published yesterday morning. The transformation stems from a June acquisition by Backed Holdings, BKKT, that's the stock in our crypto model, which took a controlling stake in the company to reposition the struggling kimono manufacturer into a Bitcoin treasury entity focused on stockpiling crypto assets and launching related financial operations. And of course, the stock went surging higher on that news. The story reminds me a lot of the Long Island iced tea company back in the 90s. If you don't remember that story or you weren't around, it's a very similar story. There's a relatively small beverage producer, and they specialized in non-alcoholic iced tea and juice drinks. And I'm sorry, I said back in the 90s. Sorry, this was in 2015. Sorry. I'm going to get back to the 90s here in a second with Global Crossing, but give me a second. So they went through a dramatic pivot in 2015 amid the emerging kind of cryptocurrency boom, and the company rebranded into Long Blockchain Corporation, LBCC. The name change and announced shift towards blockchain and Bitcoin mining technology caused its shares to surge 400% in a day. Those gains were short-lived, unfortunately, and the stock ultimately rose from 50 cents a share to $10 a share, but is now back at $1.10. Now, all this is very reminiscent of what we saw in the late 90s, where people were just jumping into whatever the latest craze was, and this was the dot-com bubble, where, again, companies that had nothing to do with the internet whatsoever just stuck .com on the end of their name, and they would see massive surge in their stock price. People were buying unrelated stocks that just had the same name. There'd be some article in the Wall Street Journal about this company that was doing something with the internet that wasn't even a public company, but there was a public company that had the same name-ish that was publicly traded, and you see that stock go up 400% a day, even though it had nothing to do with the other companies. But that was that speculative frenzy that we were in back in the late 90s. Part of that process that was going on was that companies needed to figure out a way when they had to announce earnings that they had the ability to provide some revenues. But in a lot of cases, they didn't have any revenues. They didn't actually have a business. They were hoping to have business, but they didn't have a business yet. But they were publicly traded. So what companies started doing is they would book revenue that they were told they were going to get in the future. And this is kind of some of the things that we see going on today. There's an old saying, Charles Kindenberger, who wrote, if you've never read the book, Manias, Panics, and Crashes, it's a history of financial crises by Charles Kindenberger. If you haven't read it, it's a mainstay for investors. You need to read the book, particularly now because of what's going on in the markets today. And particularly if you've never been through a bear market or been through a real crash in your investing life, I certainly encourage you to read the book. It kind of goes through history, talks about manias, panics, crashes, what happens, what causes them, etc. So it's a very, very good book. But he writes something important, which is that if something cannot go on forever, it will stop. And this is where we potentially are heading into today, and something, again, very reminiscent of Global Crossing back in the late 90s, which eventually failed. Enron was another one back in the late 90s. Of course, they were the poster child for the dot-com crisis. WorldCom, others. So we've got this handful of reports right now where companies like Microsoft, Google, Meta are kind of quietly pulling back some of their CapEx spending that they're talking about. I mean, estimates are still very high, but they're starting to kind of tailor those off just a little bit. And we'll see kind of what happens, but AI is not that different from what we saw at this phase during the first dot-com bubble. And this is kind of the 97, 98 period of the market. And that's when companies like Global Crossing, which were all the rage for, a couple of years, eventually went bankrupt. And again, I'm not saying that any of the companies, Microsoft, Apple, Google, Meta, these companies are not going bankrupt. I'm not saying that at all. Right? NVIDIA is not going bankrupt. Very different than what we saw in the late 90s. But some of the things that are going on are certainly reminiscent of that. And one of those is this recycling of money that's happening. So Oracle invested money, right? So Oracle crashed the AI bubble party on September the 10th, and they unveiled that they're announcing a $300 billion 5-year computing deal with OpenAI, right? And that was when Oracle went tearing off to the races. It was up like 20% on the day. So they're doing this 5-year computing deal with OpenAI. Now, in retrospect, Oracle has this contract. It's a future contract, future revenue with just 3 customers. Oracle also doesn't actually have the money to pay for that spending, which is now projected to last into the 2030s. And that's assuming no recession on the horizon, anything like that. So vendor finance. So this is the cycle, right? So you now have vendor financing with cash from operations. That's one thing. Vendor financing with cash from debt is something totally different. And for Oracle, it's going to require debt. Now, importantly, you've got Oracle now saying, okay, great. I'm going to do this deal with OpenAI for data centers we haven't even built yet, all based on future revenue or hopes for future revenue. So you get this kind of circular economy in artificial intelligence. You've got Oracle investing $100 billion into NVIDIA. NVIDIA turns around, invests $100 billion into OpenAI. OpenAI then takes that $100 billion, they invest into Oracle. And so now you've just got this circle between 3 companies, all based on future revenue, on hopes that this will all come to fruition. So again, I'm not saying that that's not the case. I'm not saying that it's not going to come. I mean, AI is a real thing, right? But there's a lot of expectations and a lot of hopes in this market right now in particular. There is a very high level of expectations that all this stuff is going to come to fruition. Let's go back to the 90s again. In the late 90s, there was this idea that the internet was going to be the game changer for everything. Everybody was going to generate tons of revenue coming off of the internet, and it was going to massively increase productivity, et cetera, so forth and so on. And so everybody was booking revenues and expectations well out into the future about all this revenue that was going to come in, and people were paying up massively for those valuations of those companies, right? I need to buy this today. Doesn't matter the price. I need to buy SDLI, JDS Uniphase, Global Crossing, Lucent, all these companies, because they're right in the heartbeat of this internet.com revolution. Everything's going to be tied to the internet, and it's going to be a gold mine of revenue for these companies. The internet was a game changer. It did increase productivity. It did create revenue, just not to the levels that everybody had expected it to be. There was also the dark side of productivity, which was job losses and other stuff. We're kind of in that same situation right now. Now, look, I want to be careful that you understand what I'm saying. Like, we're just looking at some things that are happening within the AI space. It does not mean that the markets are about to crash. As we saw back in the late 1990s, irrational exuberance was uttered in 1996 by Alan Greenspan, and it was 4 years later before the bubble actually popped. Bubbles can last a very, very long time, and that was actually something I posted a chart on this morning on X. Excuse me. So this is a chart of previous bubbles and how long they lasted. Roaring 20s lasted nearly 5 years. The dot-com bubble was 5 years. The Japanese asset bubble was basically about 3.5 years. The Mississippi bubble ran about 3.5 years, 3 years. You know, the Tulip Mania was about 3 years. So these bubbles can last for a while before they eventually come to reality. And what that reality is whether or not those expectations get met. And the problem with the expectations for AI right now is not that they're not going to get met. It's just that the expectations are now probably well beyond what companies can actually grow into. Here's a chart of CapEx expenditures This is big tech capex as a percent of GDP. And you just kind of see this very sharp ramp up in these capex expectations running out into the future. Now, it's not saying that we're not going to have future capex. There is going to be future capex. Companies are going to spend money on AI. There's no doubt about that. Just like we did with the internet. We built out the internet, built out fibers, all that stuff. Same thing will happen here. The problem that potentially is going on, though, now is saying, is that in order to justify the current valuations of these companies, we keep pushing up the expectations for capex. It's like, well, if they're going to spend $1 trillion on this, what if they spent $1.5 trillion? That makes the valuations more sustainable. So everybody just keeps pushing up the expectation. I don't really care if that ever happens. It's just right now it supports the narrative. So as investors, we have to temper some of our expectations about what the future is going to look like, because much like we saw back in the late, and again, the bubble can last here for a bit. And the bubble can keep going here for a while. So I'm not saying go sell your NVIDIA or go sell your Palantir stocks. I'm not saying any of that right now. They're in the heartbeat of that whole AI chase at the moment. And there's a lot of momentum behind the markets. There's a lot of people that are underweight those stocks that have got to play catch up right now. NVIDIA just broke out of a consolidation at an all-time high yesterday. Absolutely nothing wrong with that stock at the moment. So I'm not saying, I want to be really clear, I'm not talking about a major bust here. But what I am saying is that we have to be a little bit more cautious going forward and temper our expectations somewhat on a lot of these assets, because we're allowing our expectations to exceed the grasp of reality. I'll read to you something from Michael Symbolist. He says, I think this is well understood, but just to reinforce the point, AI-related stocks have accounted for 75% of the S&P 500 returns, 80% of the earnings growth, and 90% of the capital spending growth since ChatGPT was launched in November of 2022. Think about that for a moment. We've talked about breadth in the market before, right? 493 stocks really aren't growing earnings. 493 stocks really aren't doing much. But the market just keeps going up. 75% of those returns since 2022, November of 2022. Now, if that date doesn't ring a bell, that was the bottom of the market in 2022 when we had that correction from the stimulus-driven kind of meme stock frenzy that we saw in 2021. So the launch, so basically the launch of this phase of the bull market started in November 2022 when ChatGPT was launched. It was like, oh my gosh, game changer. AI is here. That was the bottom of the market. But AI is showing up in other places as well. Data centers are eclipsing office construction spending. Coming under some increased scrutiny for their impact on power grids. That was also another thing about the whole Oracle deal, right? On this build out with OpenAI. So they're going to build all these data centers. The problem is that it will take roughly about 5 nuclear reactors to power all these data centers that they're producing because of the amount of energy they're going to consume. We don't have that. So that's why people are chasing nuclear stocks like GE Vernova, Oklo, et cetera, on the come, right? I mean, the expectation is we're going to have to build all these nuclear power plants now. It takes 10 years to build a power plant. Assuming you can get, maybe you can get it down to 7 or 8 if you can get fast tracking through the government, through the red tape, but that's not anything that's going to occur soon. Oklo, as a good example, They have no revenue. We haven't built any power plants yet. It's all based on the come. Specialized power rates for most data centers, this is continuing with Michael Symbolist. Specialized power rates for most data centers aren't enough to cover costs of new natural gas plants, leaving other customers to foot part of the bill. And in the last year, 70% of last year's increase in electricity cost was the result of data center demand. The biggest medium-term risk I can think of for the top U.S. equity markets is basically this moat that has been creating their own supernode computer clusters and deep ultraviolet lithography machines of comparable quality. Don't worry about that. These companies, what that means is essentially is that a lot of these companies in the AI space have built such a big moat, nobody else can intervene into that space. So they've kind of got a lock on the markets right now. But the stunning punchline of all this, and going back to the Oracle, NVIDIA, OpenAI deal, Oracle stock jumped by 25% after being promised $60 billion a year from OpenAI for 5 years. That's $300 billion. An amount of money OpenAI does not earn yet to provide cloud computing facilities that Oracle hasn't built yet, and which will require, and this is what I was talking about a second ago about the power, and will require 4.5 gigawatts of power. Now, what is 4.5 gigawatts of power? That is basically 2.25 Hoover dams, which we haven't built yet. 4 nuclear power plants, which we haven't built yet. That also includes increased spending by Oracle, whose debt-to-equity ratio is already hovering around 500%, compared to 50% for Amazon, 30% for Microsoft, even less for Meta and Google. They're going to have to finance that through debt. So in other words, this tech capital cycle has to come from somewhere, right? And this is what I was talking about before, is that, you know, the big risk here is that there's no way for Oracle to pay for this construction out of cash flow. So they must raise equity or debt to fund those ambitions. So until now, this AI kind of infrastructure boom has almost been entirely self-funded by cash flows up to this point. But in order to meet these expectations for CapEx, for spending, et cetera, it's going to have to start coming from debt. And again, doesn't mean a debt cycle is not the end of the world, doesn't mean anything else, but the money has to come from somewhere, because at the end of the day, construction workers have to get paid. They're not going to work for free. They're not going to work on forward revenues. Yeah, we'll build this for free now and you pay us later. That doesn't happen. So at some point, that has to be a reality. So we'll see how this all works out, but the concern and the question of all this is, where's the funding for AI going to come from? Because right now it's just kind of a circular thing between three companies. You give me $100 billion, I give you $100 billion. Brent gets $100 billion, and you just keep giving it back to me. It winds up back in my pocket. So basically, I give Brent $100 million, and he gives me $100 million back, and you know he's $100 million richer, and I've got my $100 million back. I don't know how that works, but that's how it works. Everybody gets $100 million, right? At least on their books. I don't actually have the $100 billion, right? But it's on my books. So, again, this is the concern. I mean, we're talking about $2.9 trillion of global data center spend through 2028. $2.9 trillion. Now, you do the multiplier effect on that. So let's just round it to $3 trillion because that's an easier number this early in the morning. In the economy, if I'm going to build a data center, I've got to employ people. I've got to build the facility, which requires commodities. I've got to go buy the land. I've got to hire workers. I've got to build roads. I've got to build utilities, all these type of things. So there's a multiplier effect on that $3 trillion. So we wrote an article about this, is about how AI data center could solve some of the debt to GDP ratio concerns, because that $3 trillion gets about a 3 to 4x multiple in terms of what they call an economic multiplier. In other words, when I spend $1, I'm going to go build this plant, and I'm going to hire Brent to come do something there. So he's got my dollar. So I give him my dollar. He goes, spends that in the economy. He buys food and gas and other stuff. That money goes to those people, and then they spend that money, so forth and so forth in the economy, right? So that dollar multiplies within economic activity. And that's called the economic multiplier effect. And so when you do something that is infrastructure related, then that has a much higher multiplier effect than when you're doing something like Social Security payments, which don't. So you get a 3 to 4x multiple on that. So if I have $3 trillion in spend, that's going to turn out to be $9 to $12 trillion of economic activity in a $30 trillion economy. So it's not nothing. Definitely going to help boost economic activity. It's going to certainly provide for growth, more jobs, potentially, wage increases, etc. if we actually spend all that money. But if you forecast the 2.9 trillion in global data center spend through 2028, that's about 1.6 trillion-ish in hardware, chip servers, those type of things, and about 1.3 trillion on actually building the facilities themselves. That translates into investment needs of about 900 billion in 2028. And for context, total capex spending by all companies in the S&P 500 index combined in 2024 was 950 billion. So there's two significant kind of macro consequences to be looking at. One is that investment-related spending in data centers and that construction, power generation, that's going to add up to about 40 basis points to U.S. real GDP between 2025 and 2026. So there's part of that economic resurgence that analysts are hoping for next year to help support earnings growth. Will come from that 40 basis point uptick. The capital requirements to support that investment are quite staggering. And mobilizing the economy is going to be beneficial. So, as I said, the spending is not nothing. The question is going to be the financing of it at some point down the road, and how to actually make this all come to fruition. But again, this does remind me a lot. And so there is a difference between today and the late 90s. We saw a lot of the same stuff going on in the late 90s. We saw a lot of recycling of revenues, recycling of profits. It's a very similar setup to what we saw back then. The difference today is that the companies that are involved in this space are not fledgling startups. Companies like NVIDIA, Meta, Microsoft, Google, even if this completely falls on its face, let's just say AI turns into the biggest bust in human history. Nobody wants it. Google, Microsoft, NVIDIA, they'll still be in business. They're not going to go bankrupt over this. Will it hurt their stock price? Absolutely. Will these stocks be down 50, 60, 70%? Absolutely, but they won't go out of business, as opposed to what we saw back in the late 90s. Those companies had no other business. They had no other revenue. They weren't viable companies in a lot of cases. So there is a big difference. So when people make a comparison back to the dot-com bust, just understand there is a difference between today and those companies back then. But there's also a lot of similarities. And as investors, I think we have to participate in what's going on right now. And again, you look at our portfolios, we own NVIDIA and Google and Microsoft, and we own these companies. But we're watching them very carefully. And we're watching the earnings, we're watching the revenue, we're watching all this data very carefully, because there is a rising potential at some point that the expectations are going to be unrealized. And that's going to be the biggest impact on the markets, on earnings outlooks, all these type of things. The failure to meet reality is the biggest risk that investors have right now. Okay, that wraps up the show for the day. Be sure to get by the website, realinvestmentadvice.com. If you have any questions, send those to us. Always happy to answer your emails. realinvestmentadvice.com. While you're there, be sure and like and subscribe to the channel. We appreciate it very much. Michael Leibowitz will be back tomorrow with our Think Tank edition of the show. That starts tomorrow with Michael Leibowitz, getting into all the nuances of everything from Fed policy and onward. So we'll have that for you tomorrow right here on The Real Investment Show. Have a great day. We'll see you back then.